Let's talk about Deere Company, ticker symbol DE, specifically looking at their Q3 fiscal 2026. We are unpacking exactly why one of America's absolute most iconic industrial giants is currently sitting at a massive, and I mean massive, valuation crossroads. Now, when you hear the name John Deere, right, you probably immediately picture those traditional green and yellow tractors plowing a dirt field. Well, we need to completely shatter that misconception right out of the gate. Look, today's Deere is actually a highly complex, technology-enabled industrial platform. It's not just metal and diesel anymore. They are this incredibly diversified ecosystem built on heavy equipment, sure, but equally on precision agriculture, fully autonomous machinery, proprietary software, and a massive in-house financing arm. It's a totally different beast.
And you know, this shift, it completely rewrites the narrative on Wall Street. See, the old Deere was heavily reliant on the pure agriculture cycle. When farm income went up, tractor demand followed. Simple. But the new Deere is deliberately changing the game. We're now looking at agriculture paired directly with construction, autonomy, sticky recurring software revenue, and yes, even AI. And as you guys know, that kind of deep diversification commands a much higher market multiple than a cyclical equipment maker ever could.
So to really understand the valuation here, we've got to establish the baseline. For fiscal 2025, consolidated sales and revenues are sitting at a massive $45.7 billion. Now, yes, that is a 12% decline from the absolute peak we saw in 2024, with net income falling to roughly $5 billion. But hey, context is literally everything in this game. This isn't some sort of structural collapse. It's just a cyclical normalization following what was an exceptionally strong, booming agricultural period from 2021 to 2023. And what's really fascinating here is that their cash flow generation, it remains incredibly resilient despite that top-line drop.
A huge reason they can maintain that kind of cash flow through these bumpy cycles is just their absolute dominance. I mean, they have an estimated 53% market share in U.S. large tractors. Deere's economic moat is rated an 8.5 out of 10 for a very good reason. Think about it from the customer's perspective. For large commercial farmers, equipment reliability isn't just some nice-to-have luxury. If a machine fails during a tight harvest window, it can cost that farmer substantially more than the price difference between two tractor brands. Nobody, and I mean nobody, wants to gamble their entire season's yield on a budget knockoff. It's just not worth the risk. And all of this dominance feeds directly into what we can basically call the Deere flywheel. It is an almost unstoppable economic machine. It really starts with their highly underappreciated dealer network, which creates this massive installed base that competitors simply cannot replicate overnight. Seriously, it's virtually impossible. Every single machine out there in the field is constantly generating data. More machines mean more data, right? Which then feeds into better algorithms and AI, which creates better products and services, which ultimately locks in an even larger customer base. It just keeps spinning.
But listen, here is the real shocker from this recent quarter. It wasn't just agriculture carrying the weight. Not at all. It was an explosive 18% year-over-year revenue growth in their construction and forestry segment. Operating profit there absolutely exploded by 84% to $436 million. Think about that. In a quarter where precision ag was actually slightly down, construction completely stepped in as the major growth engine. It's a total game changer.
So you're probably asking yourself, why exactly is the construction segment booming right now? Well, it's driven by a highly unexpected catalyst, and that is the AI infrastructure build-out. It's pretty wild to think about, actually. Deere isn't out here selling AI chips, obviously, but they are providing the absolute physical reality required for those chips to exist. AI data centers require enormous amounts of site preparation, grading, road building, heavy utility construction, the whole shebang. This massive earth-moving requirement is a direct, tangible tailwind for Deere's excavators and loaders.
And you know, AI isn't just this macro tailwind happening outside the company, it's actively driving margins right inside their products too. Take their See and Spray technology, for example. By utilizing 360-degree cameras and machine learning to actually differentiate weeds from crops in real time, the machine selectively sprays only the weeds. The result? The farmer saves an absolute fortune on chemicals. And in return, Deere captures a massive technology premium. I mean, that is textbook moat expansion, smoothly transitioning them away from just one-time hardware sales and right into much higher margin recurring tech revenue.
So how did this all translate to the bottom line? Well, it turned into a phenomenal EPS beat. Deere delivered $5.10 per share against a Wall Street consensus of roughly $4.69. That is a massive 9% surprise. And what's genuinely impressive here is the quality of that beat. We're not talking about some clever financial engineering here. This was driven by genuine operating leverage and really disciplined cost management.
However, and we always have to dig into the details as analysts, there is a necessary caveat. That number did include about $110 million in tariff recoveries, so we've got to be careful not to just blindly annualize that 510 number without adjusting our future models.
Still, even with that adjustment, the fundamental strength across construction and their smaller ag divisions gave management the conviction to raise their full-year 2026 net income guidance. They bumped it up to a very healthy range of $4.75 billion to $5 billion. That midpoint implies somewhere around $18.05 in earnings per share. Look, in an industry known for wild cyclical volatility, seeing a guidance raise of this magnitude, it signals immense confidence from the C-suite that they are navigating this current trough incredibly effectively.
Okay, but here is where we absolutely have to pivot our analysis and introduce the primary risk to this entire thesis. Because of all this earnings strength we just talked about, the stock jumped. Using the clean pre-earnings reference price of roughly $580 a share, the forward PE, based on that new guidance midpoint, is sitting at a very steep 32.2 times. Let's be real for a second. For a cyclical industrial company, even a great one like Deere, that is undeniably expensive. No two ways about it.
The historical contrast here is just stark. If you look back, Deere's 5-year historical average PE is only about 17.4 times. Fast forward to today, and we are staring down the barrel of a 32.2 multiple. Even if you want to argue, hey, Deere deserves a premium now for his transition into this tech and software platform, a 30-plus multiple requires some extremely strong earnings normalization. The market has essentially already priced in a massive, totally flawless recovery, and that's the dangerous game.
Because if that fully priced-in recovery hits even a tiny speed bump, the downside risks are going to be severe. The overarching danger is simply that the agricultural cycle fails to actually bottom out in 2026 like management is hoping. If commodity prices stay weak, farmers are undoubtedly going to delay their capital expenditures. Then, throw in the heavy incoming tariff costs, which are estimated at a very significant $750 million in 2026 alone, and man, you have a perfect recipe for multiple compression. If earnings grow slower than expected, the stock price could contract sharply just to revert back to a normal historical valuation.
So, the big question, how do we actually approach this as investors? Because of that high valuation, a staggered dollar-cost averaging, or DCA strategy, is strongly preferred over just throwing in a lump sum. Strategically speaking, the aggressive, excellent risk-reward zone sits lower, right between $525 and $550. Then your preferred accumulation area is $550 to $580. Now, from $580 to $610, the stock is fair, but it is certainly not cheap. And honestly, anything above $610, pushing into that $650 range, that is firmly the chase zone. You really want to avoid aggressively adding capital there, unless we see earnings estimates get revised materially higher.
And this is exactly why chasing the stock limits your upside potential. When we run the discounted cash flow and normalized owner earnings models, the base case intrinsic value really sits around $460 to $550 per share. To actually justify paying a price in the high 600s or 700s today, you need the bull case to play out absolutely perfectly. I mean literally perfectly, meaning 2026 is an absolute rock-bottom trough, farm incomes rapidly bounce back, AI construction stays scorching hot, and precision ag adoption goes into complete overdrive. It's possible for sure, but it's a lot to bank on.
Which ultimately brings us to our final analytical verdict on Deere right now, and it's a saying I love. Buy the company, don't blindly buy the stock. Look, Deere is arguably one of the highest quality industrial franchises on the planet. Their moat is incredibly wide, their cash generation is elite, and their technology pivot is actively, visibly working. But valuation discipline is absolutely mandatory here. You simply cannot pay any price just because it's a fantastic business.
So, as we wrap up this explainer, the single most important question for you to watch going forward basically boils down to this. Is 2026 truly the bottom of the agricultural cycle, paving the way for a powerful earnings surge into 2027? Or is the market pricing in a perfect recovery way too early? Keep a really close eye on their large ag sales and their used equipment inventories over this next quarter, because honestly, that data is going to give us our answer.